Hello, everybody. So, of course, it's Sunday, and we have another buy from Michael Saylor. But okay, Michael Saylor, we noticed something different in your post today. Preferred. Orange is my preferred color. Emphasis on preferred. Why? Something seems to be going on with the preferred, and we noticed, most of you may have noticed that on Friday, the MSTR common shares actually behaved pretty well compared to the price action of Bitcoin. It was surprising, especially towards the end of the day on Friday. MicroStrategy common shares behaving well compared to Bitcoin not doing too well. And under the hood, one of the questions is, does this have something to do with the preferred? Easy ramping the prefers even more now. You know, I've pointed out in my prior video that it keeps increasing the prefers week after week. How well did he do this week on the preferred? And what gives me pause, what makes me think that he's very excited about the prefers, and so am I, is look at the prefers. They've traded nearly the whole week. I mean, aside from that over Friday, right? Monday was a holiday, but from Tuesday of this week, it traded above 100, specifically 101 to 102 for both prefers most of the week, and it's finished the week at 103. So this gives me pause. This tells me, are people noticing the preferred? What is going on with the demand for the preferred? Because those preferred, of course, trade at $100 par. The usual price, the borrowed price, is $100. So, and oftentimes preferred will trade below par, right? Slightly below par. That's the usual thing. But what's up? What happens when a preferred actually trades above par? Because maybe the credit market have mispriced them. Maybe those preferred are being noticed as too good, much better than the competition. What happens when they trade above $100? Well, there's two theories in my view. One of them could be that you could still sell a preferred at 100 and make your issuance of a preferred drop the price back down to 100, and that would imply that there's insane demand and you gotta print more preferreds to make them trade at $100. Or another theory is you could still issue, you know, as few preferred as you wanted, or as few prefers as you want, and actually collect the premium. The 103, the 03 is a big question. What do you do with the 03? So let's use what Saylor in his 21 Ways to Wealth, I think it was tip number 3. Let's use tip number 3. Let's use Saylor's tip. Let's ask AI. It always begins with an AI. And so what does the AI tell me? What does the AI likely told Saylor? Well, if you sell a preferred stock above the premium, at the premium, above par, it's a good thing because it reflects strong investor demand, favorable market, confidence in the firm's financial stability. But more importantly, if you issue the preferreds above par, the excess above 100, which is the amount borrowed, the excess above 100 is just recorded on the balance sheet as additional paid-in capital, which, as you probably guessed it, in the case of Saylor, is going to go towards buying Bitcoin. So you're earning an additional 3% on each $100 worth of par that you issue on the preferred. This is extremely exciting. This is furthermore exciting that additional paid-in capital, you know, it's just a gain. It's just a gain. It doesn't dilute the shareholders' control of the shares. It doesn't dilute the vote, of course, but beyond the vote, it just doesn't dilute, right? Which is the whole point of the preferred. The preferreds don't dilute, and the preferreds really can act as a savior against the price to NAV. If the price to NAV ever dropped below a 1, then Saylor can just issue some of the preferred and buy back the stock. The preferreds are just another tool in the instruments that Saylor can use to generate a yield, but that tool is becoming more and more interesting as it is trading above 100 now, above par, above the issuance price. Also, if you look at the preferred, they have been outperforming MSTR short term, which tells me, further cements my view that MSTR shares right now are undervalued. They're being heavily shorted, right? Jim Chanos, a lot of other people are saying, "Oh, I'm just selling MSTR." A lot of tourists, as I think Saylor calls them, bad people who just want to own MSTR for 6 months. As a lot of tourists moved away from MSTR and complained about MSTR and sold their MSTR to go buy GME or to go buy whatever other BTC treasury company. Well, the common shares are getting a little bit under pressure, but that's not true for the preferreds. This is not something we see for preferreds. For preferreds, which are not subject to such sell pressure, I've actually now outperformed MSTR for Strike, which is the preferred in which we have the most look back. If you look at the total return of Strike, it was issued at around $80, so it's now up 26% compared to the start price. So that's quite outstanding. And of course, for Strife, we don't have enough of a look back. It's a newer issue, but give it a week, and Strife will probably have outperformed MSTR as well. So this is quite indicative, in my view, of the fact that MSTR is very volatile, and it's now rather in the trough of the volatility. There will be a new peak at some point, but right now it's in the trough. I think the preferred, what's really important to say about the preferreds, what is implied in the preferreds, and what that was the theme of the Q1 presentation, is that those preferred, Strike and Strife, are actually probably, in my view, no investment advice, but they're probably very undervalued right now, very undervalued. And that is the point that Saylor tried to make in the Q1 call, is if we are to rate the preferreds, they have 5.8 times and 5.3 times the over-collateralization ratio. In other words, there's 5 times more cash to pay off the preferred available at MSTR. They have 5 times the cash. It's like you're lending $1 million to somebody who has a savings account with $5.8 million in it, and you're lending them $1 million. So they're going to pay you back because they have $5.8 million in the savings account, and you're lending them $1 million. For most companies, so the best, the AA-rated companies, right? The best companies, they tend to have 2 times to 3 times the cash on the balance sheet. A typical example would be you have Apple stock. Apple, say, has $100 billion on the balance sheet. They borrow 33 billion, right? That means they have 3 times over collateralized. They're 3 times over collateralized, and so they in this scenario, the best companies borrow at AA or AAA spreads. And AA or AAA spreads, which is like available to the most over collateralized company, the companies who have a lot of wealth, a lot of cash, they pay something very, very similar to the government bond yield. They pay, and sometimes lower, right? They pay a very small spread, 30 to 75 or 50 to 100. They pay a spread typically less than 1%. Now, the preferreds of Michael Saylor are charged a market credit spread of 600 to 700 basis point, 600 to 700 basis point. Yet they are better collateralized than, say, Apple bonds, right? Apple bonds are less collateralized than strategy bonds, but strategy bonds get the triple C treatment. And so the point is that these instruments should probably trade at a much lower spread. And so if they trade at a lower spread, that means they will have a lower yield. And how do they get a lower yield? Well, because they respectively yield 8% and 10%, the only way to get a lower yield is to increase the price. And so to give a big range, because this is going to be a journey, of course, to get the market to accept that these are actually over-collateralized and they're less risky. It's going to take a long while to accept. But let's assume that over the long run, Strike and Strive could realistically, in my view, trade between $160 and $200 a preferred, 160 to 200. That wouldn't be too far-fetched, assuming that the market starts to treat the preferred of MSTR like credit-rated instruments, which they're not right now. But if we care about over-collateralization, which the markets do, people are going to start to notice, and they're going to say, oh, wait a minute, this is not CVS who's tried to expand pharmacies in the era of digital everything. This is not Starbucks who's trying to do some new flavoring or something like that and spends the money with the hope of a return. No, this is a company who used the cash to buy money, Bitcoin, and the money is still there. And so, of course, the credit worthiness of his instrument is probably not triple C. No financial advice, it's probably not triple C. It's probably much, much closer to these low credit spreads. And so the price, they should probably be trading at a much higher price. And so this is the kicker here. This is a very important thing. So let's take a middle point. Let's assume the average, and this is mostly about Strike, right? So let's assume, because Strive he has a lower ATM. I'm sure he will increase at one point for Strive. But let's talk about Strike. Let's assume Strike were to trade at a 1.8 price to par, right? We probably need a new metric too. I'm gonna call it price to par, PPAR. Let's assume that Strike was trading at a 1.8 price to par. So, of course, what is never going to change is you borrowed $21 billion, right? And then a yield is earned, and that yield would be BTC growing at 30%, and then you give away the 8% in the form of a yield on the preferred, capturing the delta, right? Capturing the 22%. So they issue the money, they buy the Bitcoin, and they do an arbitrage. The Bitcoin grows at 30%. You give away 8% each year. You have much higher compounding on the BTC line. You have much lower compounding on the interest line. And so the delta between the two over time is the torque. This is well understood. This is new, though. What if you were to sell the $21 billion of prefers? What if you were to sell it at a 1.8 price to par? So all of a sudden, 80% on top of that gets added. So 21 billion plus 80% of 21 billion means you could potentially collect 16.8 billion just for the privilege of offering the market these instruments. And that money could just move to the additional paid-in capital line on the balance sheet, and ta-da, what would he do with that money? Just turn it into more Bitcoin. This is kind of like when Saylor issues convertible debt, right? He's really selling a call option and collecting that premium and selling the call option. Well, this is kind of the same way. You're collecting the premium, the delta between the par and what the market actually values your instruments at. This is quite genius. Now, I realize we are quite a ways away from trading at a 1.8 price to par, because right now we are at a 1.03 price to par. This will take years probably to get the market to recognize these instruments as, AA rated or even BBB rated. It's going to take a little while. But we're a long-term investor. I'm a long-term investor. When I look at this, I'm like, okay, well, maybe 5 years from now, maybe these instruments benefit from a price to par that is well above 100, and maybe they start selling $100 preferreds for $180. And so now I get the point, and I think you get the point why Saylor says orange is his preferred color. It prefers the orange to be preferred. And anyways, I think this is quite new and quite exciting, and that's why he emphasized that. So I look forward to reading the form tomorrow, the buy form, and see what happened to that 0.03. See if they were actually able to collect some paid-in capital. This was not investment advice, not financial advice. This is only entertainment. I'm hoping you entertained. Please like, please subscribe. Follow me on Patreon, follow me on X. Thank you for watching. Thank you for your support, and have a wonderful, wonderful day.